Hi everyone, I'm Andy, and this is the AI Breakdown. Welcome to your weekly news edition, where I'll cover what happened in AI last week and why it matters. Right, let's start with the big one, and I mean genuinely big. On the 27th of February, OpenAI announced it had closed a $110 billion funding round. It values OpenAI at a $730 billion pre-money valuation, or $840 billion post-money, and it's the largest private financing in history by a good chunk. The investor list matters as much as the number. The round was led by Amazon with $50 billion, and Nvidia contributed $30 billion, with SoftBank also putting in $30 billion. One thing worth mentioning, Amazon's $50 billion isn't necessarily a lump sum on day one. It apparently starts with about $15 billion up front, with the remaining $35 billion contingent on undisclosed conditions. But the really interesting part isn't who's on the list, it's who isn't. Microsoft didn't participate. Their longtime backer, their biggest investor, sat this one out. Now, funding rounds usually mean more runway for a company, but this one is different. It's about choosing sides. OpenAI has committed to 2 gigawatts of training capacity on Nvidia's Vera Rubin systems, and another 3 gigawatts for inference. This 5 gigawatt commitment feels more like infrastructure planning than traditional venture capital. Additionally, OpenAI is extending its AWS agreement by $100 billion. So OpenAI is integrating deeply with the AWS, and this could streamline procurement for AWS's massive user base, making OpenAI tools feel more natural within that ecosystem. So the world where Azure is OpenAI's core partner, it's a time for reevaluation. The new narrative is Amazon is positioning itself prominently in the foundational model space, altering industry competition. There's also a long-term view. OpenAI is unlikely going to be profitable for some time. This isn't a standard venture round. It's about securing supply and partnerships at a scale needed for 1 billion users. Staying on the theme of huge checks, Anthropic has also had a very big month. On the 12th of February, Anthropic announced a $30 billion Series G round, valuing the company at $380 billion post-money. That's more than double its previous $183 billion valuation from Series F, and the coverage around the round framed it as the kind of raise that starts to look like infrastructure financing as much as it looks like classic venture. The co-leads on this one were GIC, Singapore's sovereign wealth fund, DE Shaw Ventures, Dragonair, Founders Fund, Iconic, and Coatue. And then you've got a long tail of institutional money: BlackRock, Blackstone, Temasek, Goldman Sachs, JP Morgan Chase, Sequoia, Accel, Fidelity, over 30 investors in total. The reason I'm listing that out is that it tells you what kind of bet this is becoming. This isn't just venture capital chasing momentum. It's sovereign wealth funds and major financial institutions effectively saying, frontier AI is something we want exposure to at scale. And the reporting around the round made that point pretty explicitly. Sophisticated capital is treating frontier AI as a generational infrastructure bet, not a punt. What's also striking is the enterprise traction. Anthropic says its run rate revenue is $14 billion, and that it's been growing more than 10 times annually for each of the past 3 years. 2 years ago, it had a dozen customers spending over $1 million a year. In the company's own Series G announcement, Anthropic said that number now exceeds 500, and 8 of the Fortune 10 are now Claude customers. So if OpenAI is the consumer brand everyone knows, the one your non-technical colleagues mention in meetings, Anthropic is increasingly the company that shows up in serious enterprise procurement conversations. Why does it matter? Because it's starting to look like a 2-horse race at the foundation model layer. OpenAI is still valued at roughly double Anthropic after that monster round, but the adoption indicators suggest the gap may be narrowing faster than headline valuations imply. And there's a standards angle here that's easy to miss. Anthropic's Model Context Protocol, MCP, was donated to the Linux Foundation's new Agentic AI Foundation back in December 2025, with OpenAI, Microsoft, Google, and Amazon as co-founding members. That positions Anthropic not just as a model provider, but as an architect of the emerging "how do agents talk to tools" standard. My take is, if you're picking strategic partners, don't treat Anthropic as a nice backup anymore. Between the Fortune 10 penetration and the capital reserves, it's clearly one of the primary ecosystems you'll be building against in 2026. Switching from enterprise procurement, let's look at what your customers will directly engage with. Apple's long-awaited Siri overhaul is set for a March launch alongside iOS 26.4, and it's powered by Google's Gemini model, specifically a 1.2 trillion parameter version, running on Apple's private cloud compute infrastructure. The partnership itself was announced in January, and Apple's reportedly investing about $1 billion a year for access to Google's foundational AI technology under a multi-year deal. So what do you get with this new Siri? The briefing highlights on-screen awareness, deeper personal context understanding, and cross-app integration capabilities. And the architecture is worth noting. Gemini handles Siri's summarizer and planner functions, while Apple's private cloud compute ensures users' data remains isolated from Google's infrastructure. Essentially, Apple is stating, the model may be Google's, but data trust remains with us. There are also rumors of Gemini-enhanced features extending into Safari and Spotlight search. This partnership is an important milestone for Apple. They are effectively admitting that building a strong assistant internally quickly enough isn't feasible, raised by TechCrunch as the risk of handing over core logic to an external entity. Google, on the other hand, gains massive reach. Gemini becomes a vital intelligence layer for both Android and iOS, reaching over 1 billion Apple devices. Concerns about power concentration have already been voiced by Elon Musk, and antitrust debates are foreseeable. For developers of consumer or prosumer apps, the message is clear. Siri might soon be relied on for operations, not just inquiries. Cross-app integration is crucial here, as it separates basic FAQs from genuine workflow automation. Developers should prepare for users, expecting voice and assistant-driven interactions as standard. Before we continue, a quick word from our sponsor. This episode is sponsored by Notify Technology, a health and safety software partner, assisting teams in managing incident reports, audits, inspections, and risk assessments comprehensively. Plus, with Notify Spark, their AI companion, they're simplifying incident documentation and investigations, reducing administrative work, and enabling teams to focus on important issues. Learn more at notifytechnology.com. If OpenAI and Anthropic are the model layer stories, the other half of this week is the pickaxes and power stations story. Hyperscalers plan to allocate nearly $700 billion on data center projects solely in 2026. Here are some numbers from the briefing. Amazon estimates $200 billion. Google plans between $175 and $185 billion, with others matching in scale. NVIDIA's Jensen Huang set another high target, predicting $3 to $4 trillion spending on AI infrastructure by 2030, labeling it as the largest infrastructure build-out in human history, a bold and clear intention. To make these numbers tangible, some specific examples from this week's notes include a new project in Louisiana called Hyperion, covering 2,250 acres, estimated at $10 billion to establish, and expected to deliver 5 gigawatts of computing power supported by nuclear energy. Another is Google's energy initiative. They acquired a $1 billion 300 megawatt, 30 gigawatt hour iron-air battery system from Form Energy, marked as the world's largest battery. It supports a new Minnesota data center with a continuous 100-hour power supply from 1.4 gigawatts of wind energy and 200 megawatts from solar sources. That last detail, 100 hours of storage, is the one worth underlining, because the big challenge with renewables has always been what happens when the wind drops or the sun goes in for a few days. And here you've got AI demand essentially forcing the answer to that question. This is one of the first billion-dollar bets on long-duration energy storage driven specifically by AI needs, and that feels like a genuinely significant moment. But it's not all smooth sailing. There's real public pushback building. An Echelon Insights poll found that 46% of people don't want a data center in their community. Only 35% are in favor. And New York State is actually considering a 3-year freeze on new data center permits. So, the not in my backyard problem's very real for these companies. Wall Street's getting a bit twitchy too. Morgan Stanley and Bank of America are projecting that Amazon could face negative free cash flow of anywhere from $17 to $28 billion in 2026. That's a lot of red ink. And you could see the market's reaction after these spending numbers came out. Tech stocks dipped. The mood is very much, show me the money. Investors want to see returns before they get comfortable with this level of spending. So why should you care about all of this if you're a business leader? I think there are three things worth paying attention to. The first is pricing and availability. Now, you'd think with this much capacity coming online, compute costs should stabilize or even come down, but it's not that simple. Regional energy constraints could easily create bottlenecks, and bottlenecks mean higher prices or limited availability depending on where you are. So if your business leans heavily on cloud AI, it's worth watching where the providers are actually building and where they're locking in power. The second is that this is becoming geopolitics. When you're spending at this scale, it stops looking like a corporate investment and starts looking like national infrastructure. Think highways, think railroads. And that brings all the usual debates about who benefits and who pays. And third, and this one's easy to miss, the cascading effects. The same chips and supply chains feeding these massive data centers also feed consumer devices. We'll come back to this in a moment when we talk about Samsung and the memory chip shortage, because it's a really good example of how these forces connect. My take is, the sheer scale of this investment tells you that the industry considers AI infrastructure essential, full stop. Now, whether the economics actually work out is still very much an open question, but the trajectory is clear. The competitive edge in 2026 isn't just about who has the best model, it's about who secured the power, the chips, and the locations to run it. Next, a quick check-in on Workplace AI, and Microsoft's Copilot numbers give us a useful reality test. Microsoft said in its fiscal Q2 2026 earnings call on January 28th that Microsoft 365 Copilot has reached 15 million paid seats. That's a 160% year-over-year increase. They also said daily active users grew 10 times year-over-year, and conversations per user doubled. Those are strong growth metrics. But the more revealing figure is penetration. Microsoft has over 450 million paid Microsoft 365 commercial seats overall, which puts Copilot at roughly 3.3% of the installed base. So despite the hype, and despite Microsoft's distribution advantage, most organizations are still either evaluating, piloting, or just not convinced. And you can see why some teams are skeptical when even the user chatter keeps coming back to Copilot feeling a bit inconsistent across different Microsoft 365 apps. Microsoft's response is telling. It plans to abandon the $30 per user per month standalone add-on model that slowed adoption. That's the current annual billing price point, and instead bundle Copilot into a new Microsoft 365 subscription tier this year. If you've been around enterprise software long enough, you've seen this play. You distribute widely first, even if usage is patchy, and then you normalize it as part of the suite. Once it's bundled, it stops being a line item decision and becomes a governance and enablement decision. So why does that matter? Because it changes how AI adoption happens inside real companies. Instead of a few teams buying Copilot licenses and experimenting, you'll have a lot more people with access by default. The hard part shifts from procurement to things like training, data controls, and measuring whether it's actually improving output. And it's not just about Microsoft. For competitors, Google Workspace with Gemini and a whole fleet of specialist tools, bundling creates pressure. When a capability is already there in the suite you pay for, it's much harder for point solutions to justify their price unless they're clearly better. For me, achieving 15 million users is impressive, but the 3.3% penetration reveals the reality. This is still an early-stage market. While bundling could speed up adoption, it might also spotlight the gap between having AI and extracting value from AI. If you're a CTO or business leader, focus on measurement, not just adoption. Let's rattle through a few more before we wrap up. First, Snowflake and OpenAI have announced a multi-year, $200 million partnership that embeds OpenAI's frontier models, including GPT 5.2, directly into Snowflake's data cloud. The key idea is simple: bring the model to the data. Customers can use the models inside Snowflake Cortex AI and Snowflake Intelligence to build agents, generate insights, and run natural language workflows grounded in their own enterprise datasets, without shipping data out of the Snowflake environment. The briefing calls out the data gravity problem as a blocker for enterprise AI adoption, and this is one of the cleanest solutions we've seen. It's not just a plugin either. The companies say their engineering teams will co-develop enterprise workflow features using OpenAI's apps, SDKs, and AgentKit. OpenAI COO Brad Lightcap even admitted recently, "We have not yet really seen AI penetrate enterprise business processes." This kind of integration is how that changes. Next, Samsung says it plans to double the number of devices equipped with Google's Gemini AI capabilities from 400 million in 2025 to 800 million by the end of 2026. That covers phones, tablets, wearables, TVs, and appliances under its Connect Future strategy. And Samsung's mobile chief, TM Rowe, framed it as applying AI to all products, all functions, and all services as quickly as possible. Gemini handles generative tasks, while Bixby keeps device controls. Samsung also says awareness of its Galaxy AI brand jumped from 30% to 80% in 1 year. For anyone who builds mobile experiences, the implication is that AI-capable devices are about to become the default assumption, not the premium tier. The wrinkle worth calling out is, Samsung's also dealing with a global memory chip shortage, which is pressuring smartphone margins, and it didn't rule out price increases. And finally, a story that signals the social temperature is changing. On Saturday, the 28th of February, several hundred protesters marched through London's King's Cross Tech Hub, home to the UK headquarters of OpenAI, Meta, and Google DeepMind, in what organisers called the March Against the Machines. MIT Technology Review described it as one of the largest anti-AI protests organised to date, spearheaded by Pause AI and Pull the Plug, along with other groups. The concerns were across the spectrum, from AI content pollution and non-consensual image generation to labour displacement, environmental costs, autonomous weapons, and existential risks. Their central call was for a halt on training frontier AI systems until adequate regulations are established. Now, whether you agree with the protesters' demands or not, the fact that hundreds of people gave up a Saturday to march past AI offices in central London tells you something about where public sentiment is heading. And if you're building products or making strategy decisions around AI, that matters, because public trust is the one resource you can't procure with a billion-dollar funding round. Regulation is coming in some form, and the companies that get ahead of it will be better positioned than those that get caught out by it. That's all for this week's AI Roundup. If you found value in this breakdown, please leave a rating and hit subscribe. See you next week.